We move to intercorporate investment. Now, uh, in this part, we are going to learn how and when to use different type of accounting method for intercorporate investment. Now, each method that we do in the entire financial reporting, wherever we work, they affect the financial ratios and the financial statement, and it's all about getting or extracting the information in such a way where you can do comparison or you can do some justification to those numbers. So let's move here. So intercorporate investment in marketable securities are categorized generally either as investment in financial assets when the firm has no significant control over the operation of the investee firm, or it could be like investment in associates when the investment firm has significant control over the investing firm but not a total control, or a business combination when the investing firms has got a kind of total control over the operations of the investee firms. To start with, we would use the percent of ownership or voting control, which is typically used to determine the appropriate category of control for financial reporting analysis. Now, voting is something interesting. You can have different shares with different voting percentage. So even if you own 20% of a company and you have got 60% voting rights, then probably you have total control. So it's about your ability to influence or control, and these numbers are just as guideline, assuming that one share brings one vote. So financial assets, the first part here, an ownership interest of less than 20% is considered a passive investment, and there are three types of investment here. The IFRS classifies the financial assets as held to maturity, available for sale, or fair value to profit or loss, which are held for trading, and securities designated fair values. Under US GAAP, marketable securities are classified as held to maturity, available for sale, held for trading, or designated at fair value. Now, investment in associates and ownership interest between 20 to 50% is typically a non-controlling investment. However, the investor can usually have a significant influence with the investee's business operation. Significant influence can be evidenced by board of director presentation, involvement in policy making, material intercompany transaction, interchange of manager person, dependence on technology. It may be possible to have significant control with less than 20% ownership. In this case, the investor is considered as investment associate. Conversely, without a significant influence and interest between 20 to 50% considered as investment in financial assets. Now, equity method is used to account for investment in associates. Business combination is the first, and the joint venture is the second part here. So an ownership interest of more than 50% is usually a controlling investment. An investor can control the investee. The acquisition method is used. It is possible that more than 50% of even with more than 50% of investee and have no control. So for example, a country can take temporary or barriers may exist, such as bankruptcy, government intervention. In these cases, the investment are not considered controlling. So the business combination, you have to be careful. Then we have joint venture is where an entity whereby control is shared by two or more investors. The IFRS proportionate consolidation method is preferred accounting method for joint venture, although equity is permitted. In US GAAP, equity method is to be used. Proportionate consolidation is not allowed in US GAAP except in a very limited situation. So this is our final picture that we have, the ownership, degree of influence, and accounting treatment. Now, reporting of intercorporate investment, the first part is financial assets. So investment ownership less than 20% is considered passive. The acquisition of financial asset is recorded at cost, presumably at the fair value of acquisition, and any dividend or interest is recognized in investee's income statement. Recognizing the change in fair value of financial asset depends on their classification as either held to maturity, held for trading, or available for sale. Firms can also designate financial assets and financial liabilities to fair value. So let's look at held to maturity. Held to maturity securities are debt securities acquired by the intent and the ability to held to maturity. The securities cannot be sold prior to the maturity except in unusual circumstances. Long-term held to maturity securities are reported on the balance sheet at amortized cost. Amortized cost is usually the original cost of the debt plus any discount or minus any premium that has been amortized to date. Amortization cost is simply the present value of remaining cash flows, coupon payment and face amount discounted at market value of interest ratio. Interest income, coupon cash flow adjusted for amortization or premium or discount is recognized in the income statement, but subsequent change in the fair value are ignored. Then we have held for trading, designated at fair value and available for sale. So held for trading are debt or equity security acquired for the purpose of profiting in near terms, usually less than 3 months. Held for trading are reported at fair value. The changes in fair value both realized and recognized in income along with any dividend or interest income. This part is simple. So if it's held for trading, which means that it is a trading asset and you will trade it. So this is like the most liquid part of all of them. Now designated at fair value, firms who can choose to report debt equity that otherwise would be treated held to maturity asset at fair value. Designating final liabilities can reduce volatility and inconsistent results from measuring asset using different valuation basis. Unrealized gains and losses on designated liability are recognized income statement similar to held for trading. Designated at fair value is very similar to the other part, which is held for trading. Now, the designated at fair value, the US GAAP uses the term, while RFIS uses the term fair value to profit or loss. When we move ahead, we have available for sale securities that are debt or equity that are neither held to maturity nor held to trading. So we are in between somewhere. Like for held to trading security, available for sale securities are reported on the balance sheet at fair value. However, only realized gain or losses and dividends income are recognized in the income statement. The unrealized gain and losses are excluded from the income statement and reported as separate component of stockholders' equity. And the US GAAP, the unrealized gain losses are reported as other comprehensive income section of stockholder equity. When the securities are sold, the unrealized gains are removed from the OCI so that they are now recognized in the income statement. So the idea is that since you are not trading them directly, you cannot move the net income up and down due to that. And but you still want to make sure your equity reflect every of this problem, otherwise this bubble would just keep on going up. So you still need to adjust that. So you'll go to the balance sheet and recognize this as an OCI item. So the final chart, the summary of classification, the balance sheet and income statement treatment is what we are concerned about. Then we have reclassification of financial assets. IFRS typically does not allow reclassification of investment into or out of fair value to profit or loss category. Reclassification of investment out of held for trading is severely restricted under IFRS. Debt securities classified available for sale can be reclassified as debt to maturity if the holder intends to hold the debt to maturity. The security balance sheet is remeasured to reflect its fair value at the time of classification. Any difference between the amount and the maturity value or any gain or loss that is recognized in other comprehensive income is amortized over securities remaining time. Held to maturity securities can be reclassified as available for sale if the holder no longer intends to keep the debt to maturity. The carrying value is remeasured to security fair value with any difference recognized in other comprehensive income. Note that the classification of held to maturity security may prevent holder for classifying other debt as held to maturity or require other held to be classified as available for sale. The US GAAP does permit securities to be reclassified in and out of held for trading or designated at fair value. Unrealized gain are recognized in income statement at the time of securities reclassified. For investment transferring out of available for sale category, the cumulative amount of gains or losses previously recorded other companies recognized in income statement. So then we have the impairment of financial assets. So if the value that can have been recovered for a financial asset is less than the carrying value and expected to remain, the financial asset is impaired. The IFRS and US GAAP require the HTM available to be evaluated for impairment at each reporting period. This is not necessary for held to trading because we already recognize them in income statement. So US GAAP, under US GAAP, a security is considered impaired if decline in its value is determined to be other than temporary. Both HTM and AFS securities written down to fair value is treated as realized loss. US GAAP reversal or subsequent reversal of impairment losses is not allowed. Under IFRS, as under US GAAP, the impairment under IFRS are recognized in income statement. Impairment of debt or equity is indicated if at least one loss event has occurred and its effect on security cash flows can be estimated. Loss due to occurrence of future events are not recognized. Then we have IFRS reversal, analysis of investment in financial assets, and then finally the investment in associates would be our next topic. So we are now currently into impairment of financial asset. For debt securities, loss can even include default on payment or principal, bankruptcy. However, a credit rating downgrade or likewise are not considered as an impairment. For equity, is a loss event that has occurred if the fair value has experienced substantial or extent decline below its carrying value, or if the changes in business environment facing the equity issuer, such as economic, legal, or technological development, if held to maturity, has impaired, its carrying value is decreased to present value. Then we have IFRS reversal. The held to maturity securities recovers in the later period and its recovery can be attributed to an event. Impairment loss can be referred. Impairment of available for sale may be reversed under the same condition. Reversal of impairment are not permitted for equity securities. Analysis of investment in financial asset. When a firm with investment in financial asset and you are analyzing that, it's important to separate a firm's operating results from the investment result. So you would like to separate the interest income, the gains and the losses. So for comparison purpose, using market value for financial asset is generally preferred. Also, it is necessary to remove non-operating assets while calculating returns on operating asset ratio. Finally, the analyst must assess the effect of investment classification on reported performance. Investment results may be misleading because of inconsistent treatment of realized gains or losses. For example, if security prices are increasing, investors that classifies investment for held for sale will report higher earning than if we would have recognized it as available for sale. This is because unrealized gains are recognized in income statement for purchasing and then here stock credit for the available for sale securities. So of course, the way in which you recognize them affects that. Then we have investment in associates, which would be our next topic.